Welcome to Wall Street. Understanding the stock market. The stock market can seem like a scary place, full of confusing jargon and risky bets. Terms like bull market, bear market, dividends, and capital gains can make it feel like you're learning a new language, but it doesn't have to be that way. With a little bit of knowledge and understanding, you can demystify the stock market and see it for what it truly is. At its core, the stock market is simply a place where buyers and sellers come together to trade pieces of companies, called stocks. These transactions happen in stock exchanges like the New York Stock Exchange or NASDAQ. These stocks represent ownership in those companies, and by buying them, you're essentially becoming a part owner. This ownership gives you a claim on part of the company's assets and earnings. Think of it like buying a slice of your favorite pizza place. When you own a slice, you have a stake in the entire pizza, and you benefit when the pizza place does well. As a part owner, you'll share in the profits or losses of the business. This means if the company performs well, you could receive dividends, which are a portion of the company's earnings distributed to shareholders. If the pizza place does well, your slice becomes more valuable. This increase in value is known as capital appreciation, and it's one of the main ways investors make money in the stock market. If it struggles, your slice might be worth less. This is the risk you take when investing in stocks, but it's also what makes the stock market exciting and potentially rewarding. The stock market is where these slices of companies are bought and sold every day. It's a dynamic and ever-changing environment influenced by a variety of factors including economic indicators, company performance, and global events. It's a vital part of our economy, allowing businesses to raise capital for growth and expansion. Companies issue stocks to raise money for new projects, research and development, and other business activities. And for individual investors like you and me, it offers a chance to participate in that growth and potentially build wealth over time. By investing in stocks, you can take advantage of the growth of successful companies and benefit from their success. So, whether you're a seasoned investor or just starting out, remember this. The stock market is a powerful tool for building your financial future. It's important to educate yourself, stay informed, and make thoughtful investment decisions. By understanding the basics and following some simple principles, you can navigate this exciting world with confidence and success. Diversifying your investments, staying patient, and keeping a long-term perspective are key strategies for success. Now, let's dive into some key concepts that will help you understand how the stock market works. We'll explore topics like market indices, stock valuation, and the impact of economic indicators on stock prices. Stocks, shares, and exchanges. The basics. Understanding these fundamental concepts is essential for anyone looking to navigate the financial markets successfully. Before you start throwing your money around on Wall Street, it's crucial to understand the basic building blocks of the stock market. This knowledge will not only help you make informed decisions, but also protect you from potential pitfalls. The stock market can seem complex, but at its core, it's built on a few simple principles. Let's break it down step by step. First, up stocks and shares. These terms are often used interchangeably, and for good reason. They both represent a unit of ownership in a company. When you hear someone talking about buying stocks or shares, they're essentially talking about the same thing. It's a way for individuals to own a piece of a company. They both represent a unit of ownership in a company. This means that as a shareholder, you have a claim on part of the company's assets and earnings. Think of a company like a giant cake. When a company goes public, it divides that cake into millions, sometimes billions of tiny slices called shares. Each share represents a small piece of the overall company. When a company goes public, it divides that cake into millions, sometimes billions of tiny slices called shares. This process is known as an initial public offering or IPO. When you buy a share of stock, you're buying a tiny slice of that company. This means you become a part owner of the company, no matter how small your share might be. The more shares you own, the bigger your slice of the cake, and the greater your ownership stake in the company. This can also give you certain rights, such as voting on important company decisions. Now, where do these shares get traded? This is where stock exchanges come into play. They provide a platform for buyers and sellers to come together and trade shares. That's where stock exchanges come in. They act as intermediaries, ensuring that trades are conducted fairly and efficiently. Stock exchanges are like giant marketplaces where buyers and sellers come together to trade stocks. These exchanges provide the infrastructure needed to facilitate these transactions. You've probably heard of the New York Stock Exchange, often pictured with traders in colorful vests ringing a bell. This iconic image represents the hustle and bustle of the trading floor. The NYSE is the world's largest stock exchange by market capitalization, meaning the total value of all the companies listed on it. This makes it a crucial player in the global financial markets. Another major player is the Nasdaq, known for its focus on technology companies. Many of the world's leading tech giants, like Apple and Microsoft, are listed on the Nasdaq. The Nasdaq is an electronic exchange, meaning trading happens entirely online without a physical trading floor. This allows for faster and more efficient trading. Both the NYSE and Nasdaq play a vital role in facilitating the buying and selling of stocks, connecting investors from around the globe. They ensure that the market operates smoothly and transparently. But how do you keep track of the performance of thousands of companies traded on these exchanges? This is where stock indexes come into play. They provide a snapshot of the market's overall performance. That's where stock indexes come in. Indexes like the Dow Jones Industrial Average and the S&P 500 track the performance of a select group of stocks, giving investors a sense of how the market is doing as a whole. Understanding these basics is the first step in becoming a savvy investor. The IPO process, from private to public. You've probably heard the term IPO thrown around in the financial news. But what does it actually mean? IPO stands for Initial Public Offering, and it's the process by which a privately held company offers shares of its stock to the public for the first time. Think of it like this. Imagine your lemonade stand is so successful that you want to expand and open multiple locations. You need more money to do so, so you decide to go public. You work with investment bankers to determine how many shares to offer and at what price. This is called the IPO price. On the day of the IPO, your company's stock starts trading on a stock exchange. Investors can now buy and sell shares of your lemonade stand, and the price will fluctuate based on supply and demand. If investors believe your company has strong growth potential, demand for your stock will be high, and the price will go up. IPOs can be exciting events, often generating a lot of media attention and investor interest. However, it's important to remember that not all IPOs are created equal. Some companies soar after going public, while others struggle to live up to expectations. Now that you understand how companies go public, let's explore how buying and selling actually happens on the stock market. Section 4. Buying and selling market orders versus limit orders. So you've decided to dip your toes into the stock market and buy some shares. This is an exciting step towards potentially growing your wealth and becoming more financially savvy. But how do you actually make that happen? The process might seem daunting at first, but it's quite straightforward once you understand the basics. Well, you'll need to open a brokerage account, which is like a bank account for your investments. This account will allow you to buy, sell, and hold various financial assets such as stocks, bonds, and mutual funds. Once you've funded your account, you can start placing orders to buy or sell stocks. Funding your account typically involves transferring money from your bank account to your brokerage account. There are two main types of orders: market orders and limit orders. Understanding the difference between these two is crucial for executing your trades effectively. A market order is like saying, buy me this stock at whatever price it's currently trading at. This type of order is executed almost immediately, making it the fastest way to buy or sell a stock. It's the fastest way to execute a trade, but you might end up paying more than you intended if the price is volatile. Market orders are best used when you need to buy or sell a stock quickly and are less concerned about the exact price. A limit order, on the other hand, gives you more control over the price you pay. This type of order allows you to specify the maximum price you're willing to pay to buy a stock or the minimum price you're willing to accept to sell a stock. With a limit order, you set a specific price at which you're willing to buy or sell. This can be particularly useful in a volatile market where prices can change rapidly. For example, you could place a limit order to buy 100 shares of Apple at $150 per share. This means your order will only be executed if the stock price drops to $150 or lower. Your order will only be executed if the stock price reaches your limit price or lower. This gives you more control over the price you pay, but it also means there's no guarantee your order will be filled. Limit orders are a great way to manage risk, but there's no guarantee that your order will be filled. If the stock price never reaches your limit price, your order will remain pending, potentially missing out on other opportunities. If the stock price never reaches your limit price, your order will remain pending. This can be frustrating, but it's a trade-off for having more control over the price you pay. Now that you know how to buy and sell stocks, let's talk about the different types of investors you'll encounter in the market. Understanding the various strategies and goals of different investors can help you refine your own approach and make more informed decisions. Section 5. Retail versus institutional investors. Who's trading? When you think of stock market investors, you might picture individuals like yourself buying and selling shares through their brokerage accounts. These are known as retail investors, and they make up a significant portion of market participants. But there's another category of investors that wields considerable influence in the market: institutional investors. These are large organizations that manage vast sums of money on behalf of others. Think pension funds, mutual funds, hedge funds, and endowment funds. Institutional investors have much larger portfolios and resources compared to individual investors. They often employ teams of analysts and portfolio managers to research and execute trades. Their trading activity can significantly impact stock prices, especially in the short term. While retail investors and institutional investors have different levels of resources and expertise, they both play an important role in the stock market ecosystem. Understanding the motivations and strategies of different types of investors can provide valuable insights into market dynamics. Now that you know who's trading, let's explore some of the different investment strategies you can employ.